Self-employed taxes explained. What you need to know. Most self-employed people are leaving thousands of dollars on the table every single year. And they don't even know it. I'm talking about the difference between paying $30,000 in taxes versus paying $10,000 in taxes on the exact same income. That's not an exaggeration. That's the self-employed tax gap. And today I'm breaking down exactly what you need to know so you stop overpaying. Hey, I'm your host. And if you're freelancing, running a side hustle, or building your own business, this video is literally going to save you money. Stick around. Part 1. The Self-Employment Tax Trap. Let's start with the biggest thing nobody talks about. When you work a normal job, your employer pays half of your Social Security and Medicare taxes. That's about 7.65% of your income right there. You never see it leave your paycheck because your employer handles it. But here's what happens when you're self-employed. You pay both halves. You're the employee and the employer. That's 15.3% of your net profit going straight to Social Security and Medicare. On a $50,000 year, that's $7,650. Just gone. Most people don't realize this until April when they're doing their taxes and suddenly owe way more than they expected. That's the trap. But here's the move. That's where deductions come in. And this changes everything. Part 2. Deductions are your superpower. Every single dollar you can deduct is a dollar you don't pay income tax on. You still pay self-employment tax on your net profit, but reducing your adjusted gross income means you're not getting hammered on both sides. Let me give you real numbers. Say you make $75,000 as a freelancer. Without deductions, you're looking at roughly $19,000 in federal income tax plus self-employment tax. That's ugly. But let's say you properly deduct $15,000 in legitimate business expenses. Now your taxable income drops to $60,000. You just saved roughly $4,500 in taxes. And you already spent that $15,000 on actual business stuff. Here's what counts. Your home office. If you have a dedicated space in your home where you work, you can deduct the square footage percentage of your rent or mortgage. Utilities, internet, everything. Lots of people miss this one. Software and tools. Accounting software like QuickBooks, design tools, project management apps, all deductible. Equipment and supplies. Laptop, desk, monitor, headphones if you need them for work. Office supplies, everything. Vehicle expenses. If you drive for work, you can either deduct actual mileage at the IRS rate, which is 67 cents per mile in 2024, or track all your actual expenses. Mileage is usually easier. Phone and internet. A portion of your bill if you use it for business. Health insurance. This is huge and people miss it all the time. You can deduct your health insurance premiums as self-employed health insurance. That directly lowers your taxable income. Part 3. Quarterly payments and the Roth IRA strategy. Here's the other thing that trips people up. You don't get to wait until April to pay taxes. You're supposed to make quarterly estimated tax payments. April, June, September, and January. If you don't, you face penalties. The calculation is simple. Look at what you think you'll make this quarter. Estimate your tax liability, and pay it. Use the IRS Form 1090-ES. Seriously. Set a calendar reminder. Now here's where it gets smart. Once you understand your tax liability, you can use that to plan your retirement savings. A Roth IRA is your friend. You can contribute $6,500 per year into a Roth IRA as of 2024. And while it doesn't reduce your taxable income directly, it lets you build wealth tax-free. But the real move for self-employed people is a solo 401k. You can contribute up to $69,000 per year as of 2024. Part of that comes from your employee deferral, part from employer contributions. This actually reduces your taxable income. Fidelity and Charles Schwab both offer solo 401ks with zero setup fees. You can open one in about 15 minutes. Part 4. Put this into action. So here's what you do starting today. 1. Track every business expense. Use a spreadsheet, a note in your phone, or accounting software. Just start now. 2. Set up quarterly tax payments. Don't wait until April. 3. Talk to a tax professional or accountant. 20 to 30 years of experience costs maybe $200 to $500. And it saves you thousands. 4. Open a solo 401k if you're serious about building wealth. This is how self-employed people stop getting crushed at tax time. Master this and you're literally ahead of 90% of freelancers and business owners. If this helped you, smash that subscribe button. We're breaking down personal finance strategies every single week. Thank you for watching, and I'll see you in the next video.